Okay, great. Good afternoon, everyone, and welcome to BAFA Corporate Governance Knowledge Lab. My name is Samone Elmi. I am one of the workshop organizer for BAFA Corporate Governance, and I'm going to chair and moderate today's session. Thank you very much for joining us. I just want to remind you about some housekeeping points. Please keep your microphones muted, and please feel free to ask any questions that you have in the chat sections, but at the end of the session, we will leave some time for you to unmute yourself and ask any questions that you have. It's a real pleasure to introduce our speaker today, Dionysia Katelouzou. Dionysia is a reader in corporate law and corporate governance at King's College London. She is a research associate at Center for Business Research and a research member of the European Corporate Governance Institute. She specializes in comparative and transnational corporate law, corporate governance, and financial regulation, with a particular focus on institutional investors and stewardship. Dionysia is internationally recognized for her interdisciplinary research and policy engagement. She also leads the Global Investor Stewardship Project and has secured major research grants. Her work engages closely with regulators, policymakers, and also international organizations and contributes to key debates on the future of corporate governance and sustainable finance. We are all looking forward to her insight and the discussion to follow. So with that, I'll hand over to Dionysia. Thank you very much.
Thank you. Thank you very much, Amanda, for the introduction and for the invitation. And thank you to the British Association of Corporate Governance for hosting this event. It's a real pleasure to be here and to have the opportunity to share with you this work. So what I'm planning to do in the next 40 minutes is to step back from day-to-day debates about engagement, ESG, and disclosure, and instead reflect on a more fundamental question. And the question is, what investor stewardship is now being asked to do, and whether the current frameworks are equipped to support that role. So let me start with a very simple question. And the question is, what happens when those entrusted with guarding the world's capital succeed at delivering financial returns, but fail to grapple with the broader responsibilities that now come with that power? And I think the question is really important. Over the last few decades, institutional investors have become central actors in corporate governance and in the economy more broadly. Pension funds, asset managers, insurers now sit at the heart of capital and at the heart of corporate oversight. And whether they welcome it or not, the management of systemic risk. At the same time, the frameworks we rely on to understand and regulate the role of those institutional investors have not kept pace with that change. In the UK, for instance, we have built an entire governance ecosystem around the expectation that institutional investors will act as stewards, that institutional investors are going to monitor the boards, engage in strategy, respond to system-level risks such as climate change. And at the same time, for those who are familiar with UK company law, most institutional investors have no obligation to exercise that power at all. Instead, we see a variation. For instance, we see pension funds intensifying engagement, whereas others choosing divestment. And we need to understand that these are not simply technical choices. They reflect something really important. They reflect the fact that stewardship is a space in which responsibility is taken in different ways from different institutional investors. So what I'm going to present to you today grows out of my forthcoming book, which you can see on your slide, The Path to Enlightened Investor Stewardship. This book is going to be published by the Cambridge University Press, hopefully in April, late April or early May, and brings together, I would say, more than 10 years of work on institutional investor stewardship. So what I want to do today is not, of course, to go through the whole book, but specifically to ask a fundamental question, or at least what I think as the most fundamental question. And that is, what is investor stewardship actually for? My core argument in the book is that we're witnessing a really important shift from shareholder power, understood narrowly as firm level oversight, to a form of investor stewardship that carries systemic responsibilities. And we see that already in practice. We see that in regulation and also in the expectations. But I think it remains conceptually underspecified and institutionally fragile. So I suppose then you are going to ask, okay, why now? Why this question becomes so urgent now? Why stewardship becomes urgent today? I think there are three main reasons. First, scale and concentration. Institutional investors are no longer marginal market participants. They have diversified portfolios, they span asset classes, they span jurisdictions, and they are structurally positioned as system level actors. Secondly, the nature of risk has changed a lot. Many of the most significant risks investors now face are not diversifiable. Think of climate breakdown, biodiversity loss, geopolitical instability, supply chain fragility. All these are systemic rather than firm specific. They cannot be diversified away, and they cannot be managed through firm level engagement or through exit. Thirdly, the dominant model of shareholder capitalism is under strain. The governance framework, which is built around short-term value maximization and firm-level monitoring, struggles to account for those externalities and struggles to account for long-term resilience. So if you take those three factors together, you can see why institutional investors are being exposed in a very strange position. They are relied upon by regulators, by policymakers, by the public as well, to act as responsible stewards of capital. But at the same time, they continue to operate within legal, fiduciary, and commercial frameworks that remained anchored in a kind of a client and beneficiary-centered duties. So as a result, I think that stewardship is being asked to do far more work, both normatively and institutionally, than it was ever designed to bear. And this is the expansion that sets the problem that I'm focusing on in this work. So the core puzzle, as I'm trying to explain, is that investor stewardship has expanded dramatically in terms of scope, in terms of ambition, but there is no corresponding expansion in conceptual clarity or institutional support. I'm sure that you're all aware that stewardship, especially in the UK, was introduced in 2010 with the first 2010 UK Stewardship Code, which was revised in 2012. And the original idea was, let's try to make passive investors active ones. So the original idea was very simple. You have passive investors, and what you try to do is to make them monitors. And of course, this was a way to improve corporate governance and to improve engagement in listed companies in the aftermath of the financial crisis of 2007, 2008. So originally, the aim of stewardship was very simple. It was firm specific, it was equity focused, and grounded in the idea, in that very classic corporate governance idea, that better monitoring can support long-term value. So the logic was simple. And that logic still matters, but I think we need to make clear that this logic does no longer capture what stewardship is currently expected to do. And just to be clear, stewardship today is no longer confined to public equity. It includes multiple asset classes, including fixed income, private equity, infrastructure, real assets, and increasingly includes more than firm level engagement. It includes portfolios, it includes the whole market. So everything relating to capital allocation, financing terms, exit, portfolio construction now shape what stewardship is about. So it's not just about shareholder voting and engagement. And the result, of course, is that stewardship becomes overloaded because it is expected to deliver not only good corporate governance as the original idea, but also it is expected to provide accountability, sustainability, public legitimacy across different assets, across portfolios, across systems. But at the same time, it remains voluntary. It remains weakly enforced and conceptually underspecified. And this ambiguity, I think, shows up very clearly in practice. And that's why for some investors, stewardship still means voting and engagement in public companies, whereas in others, it extends to capital allocation, lending decisions, infrastructure governance, or systemic risk intervention. And for the beneficiaries and the wider public, if you think about them, stewardship often remains a promise without a clear institutional anchor. So unless we can answer those questions, unless we can answer what stewardship is for, who is it for, and how is it governed, we remain with a promise, but with no real institutional anchor. So these questions go to the heart of how institutional investors exercise power, how this power is justified, and how it is also constrained. So the rest of my talk today tries to respond to this puzzle by stepping back from labels and by asking, how should we understand responsibility when power is exercised at a distance through institutional investors on behalf of others? So that's what the puzzle that I'm trying to solve in the book is about. So I think to answer that, we need to step back before we move forward. And the reason why I'm saying that is because stewardship is not new. The term stewardship has a very long history, which predates modern corporate governance and even modern capitalism. So if you look at the term historically, you will find that in medieval times, stewardship referred to the role of a guardian, somebody entrusted with resources, with power or authority to act on behalf of others, with an obligation to care, an obligation to preserve and act responsibly. So stewardship was not an owner, but it wasn't just an agent. It was accountable for how power was used. So if you now look at different if you look at different literatures, for instance, in accounting or management or governance studies, you will find this understanding of a steward as somebody who acts on behalf of others with an obligation to care. Now, in the corporate governance scholarship, I think we need to remind ourselves that stewardship has been mainly associated with managers, not investors. I'm sure that you're all familiar with the stewardship theory of management by Davis, Schurman, and Donaldson, who try to conceptualize managers as stewards, not just for the company, but for the public good. Shareholders in that corporate governance literature, in that corporate governance tradition, were not perceived as stewards, except, of course, in the case of family owners or controlling shareholders. So I think this is really important because this makes us to understand that when stewardship migrated into investor governance, the language traveled, the language of stewardship traveled, but the conceptual foundations did not fully travel with it. So when the first code was introduced by the Financial Reporting Council, stewardship became associated with practices like voting, engagement, and monitoring. But there was no clear account of what kind of responsibility was being exercised or for whom that responsibility was exercised. So I think that it is because of that historical narrowing that we face the problem that we face today. Let me also go to a very familiar narrative, the principal agency narrative. I think we are all familiar with this classic narrative where shareholders are principals and managers are agents. And governance is about controlling agency costs. So this story has a very strong explanatory power, and it has influenced corporate governance literature and corporate law very much. But it rests on a critical assumption, on the assumption that shareholders themselves are the principals. Let us now think about institutional investors. Let us now think about the modern investment reality. When it comes to institutional investors, that assumption does no longer hold. Because pension funds, asset managers, insurers, who are the ones that dominate today's public equity, act as intermediaries. They are not the final owners of capital, they are agents in the first instance. And this creates, of course, what has been described as agency capitalism, which was famously described by Gilson and Gordon in a very popular paper in 2013. So the problem here is that you have layers of delegation, you have multiple principals, you have diffuse beneficiaries, and growing accountability gaps. Because imagine that asset managers act as agents for asset owners. The asset owners act as agents for beneficiaries. But at the same time, the asset managers, when stewardship is delegated, they also act as principals vis-a-vis the corporate managers. So no one quite fits the role of a single coherent principle. Before going further, let me be clear about what I'm not saying. I'm not saying that the agency theory is wrong. What I'm saying is that it is incomplete. Agency theory is very good at explaining the costs of the system, is very good in explaining free riding, short-termism, or misaligned incentives, but it struggles a lot to explain how responsibility should travel through these layers of power. It tells us why investors may engage or why they do not engage, but it does not tell us how power should be exercised or for whom. And this is where stewardship enters, not as a replacement of the agency theory, but mostly as a framework addressing responsibility and accountability. So this is what I'm saying, the agency narrative is insufficient, and we need something more to address exactly that point, to address the point how power should be exercised across the investment chain. Now, to address that, in my book, but also in previous work, I'm introducing a tripartite framework for understanding institutional stewardship. And this framework is built on the idea that institutional investors exercise power on behalf of others and for others. Now, what is really important to highlight here, and that's something that sometimes we forget, is that the others on behalf of whom investors exercise the power are not necessarily the same as the others for whom the power is exercised. Let me give you an example. When you have, for instance, an asset manager with delegated stewardship, the asset manager acts on behalf of the client. Let's say the client is a pension fund. Okay? So the asset manager in that case exercises all stewardship on behalf of the client. But that's not the end of the story. Because the pension fund, as a steward itself, exercises stewardship on behalf of the beneficiary. And of course, the asset manager, as a steward acting on behalf of the asset owner, also exercises stewardship for those end investors, for those beneficiaries, even though there is no contractual link or legal link between the asset manager and the end investor. Let me show you how this model works in the case of shareholder stewardship, just to make it a bit easier for you. So, and just to exemplify what I'm talking about. So, when I'm talking about shareholder stewardship, I mean exercise of investor power through equity holdings. So through voting, engagement, and escalation. So that's the classic model of stewardship. Of course, it's just one expression of stewardship is not the limit. So as I said before, the first element of stewardship is exercise of power. So when we are talking about shareholder stewardship, exercise of power is about voting, engagement, escalation, exit. Is what is often described as the corporate governance side of stewardship, right? It's everything that we in this session are familiar with. And of course, this, if we think from the perspective of the rights, this relies a lot on company law and shareholder rights, right? Because the more shareholder rights you have, the easier it is to engage and monitor. Now, this is just one element of stewardship. The second element is all this power is exercised on behalf of others. And those others are the clients and beneficiaries under mandates, under contracts, under regulatory duties. This element sits outside company law. This element of intermediation and delegated authority, I describe that in my work as the investment management side of stewardship, and this is about investment management regulation. It is about duties, it's about mandates, trusts, and contracts. So, and I think I need to clarify that under company law, institutional investors as shareholders have rights. They do not have duties. But that's not the end of the story, because they do have duties under investment management regulation. They do have duties under mandates, under contracts, and under trusts. But those duties belong to those clients and proximate beneficiaries. And this brings us to the most difficult, but at the same time, the most important question. For whom those institutional investors act? Under investment management regulation, they do, of course, act for the proximate clients and beneficiaries. But if you go back to the first stewardship code, even the 2010, right, the origins of stewardship, you will read from the first page of the code that stewardship is about promoting long-term value for the companies, for the society, for the environment as a whole, right? So where is that? Where are those others in that stewardship framework? So here in the book, but also in previous research, I'm looking at management literature and the notions of psychological ownership or active ownership, and try to look at a kind of a form of trusteeship oriented, not, it's not about altruism. It's not about institutional investors act for others because of altruistic motivations, but is more about they act for others in a way that a board act as a trustee for the company. So it's the kind of the same analogy here. Of course, I think to understand that, the others element, we need to understand that stewardship is not just one relationship. Rather, there are many different relationships of stewardship if you think about the investment chain. Here you have a simple diagram that shows how capital flows from individual savers through pension funds, insurance companies, to asset managers, and ultimately into investee assets. And the asset can be anything, right? It can be a company, infrastructure, debt, real asset. This is not, of course, about ownership. It's not an ownership story, but it's about delegation. It's about accountability. It's about power exercised at a distance. So what I want to show here is that at every point in this chain, power is delegated. And as the power moves, accountability thins. And this is precisely why we need stewardship. So stewardship, in my view, is an attempt to reconnect power with responsibility. So let me show you those four relationships that are represented in the diagram. First, you do have relationship one. You have the client stewardship, right? So that's the relationship between the asset manager and the asset owner, and then the asset owner and the end investor. So I gave you before the example. When a pension fund delegates stewardship to an asset manager, there is a client relationship between the asset owner and the asset manager, but at the same time, there is a client relationship between the pension fund and the end investors. And this, as you can see, the arrows here are not dotted. And the reason for that is because that's the only relationship which is covered by hard law. Semane, I suppose you can see my mouse, right? So when I point, you can. Perfect,
Yes.
right? Perfect. So now, what is relationship two? Relationship two is what I call end investor stewardship. So this is how the asset manager, acting as a steward on behalf of the direct client, at the same time needs to take into account the interests of the end investor. So it's the relationship between the asset manager and the end investor. And as you can see here, you have dotted lines because that's not covered by hard law. There is no contract. The only contract is between the asset owner and the asset manager. Still, though, the asset manager as a steward expects to act on behalf of those end investors, on behalf of future generations and future beneficiaries. Now, stewardship is not just about that. And given that we are all here corporate governance experts, originally stewardship was mostly about relationship three. The relationship between the asset manager, the shareholder as a shareholder, and the company. That corporate governance aspect of stewardship. And this is what I call asset stewardship, because of course nowadays it's not just about public companies, right? It's stewardship along all the assets. And following the 2020 revision of the UK Stewardship Code, you also have relationship four, which is what I call sustainability stewardship. And this moves to those non-diversifiable risks that I mentioned before. It is about addressing systemic risks and public interest concerns like climate change, biodiversity laws, labor standards, or financial stability. Again, what I want you to take from here is that only one of those relationships, and that's the client stewardship, is fully anchored in hard law, in investment management regulations. The others are governed primarily by soft law, by norms, and by evolving directions. And of course, this creates conflicts, and this creates different incentives. And I think this brings me to the next question. And the next question is, if stewardship is exercised across this chain, and if stewardship stretches beyond the clients to all of those different levels, who are exactly the others? Who are exactly those others that investor stewardship is meant to serve? And this question goes to what I call in one of my previous papers as the unseen others, the unseen others of the investment chain. So when I'm talking about others here, I'm not talking about the clients, I'm not talking about the proximate clients, but I'm talking about those who are affected by investment decisions. Because obviously, investors are formally accountable to clients and beneficiaries. This is the legal core of stewardship, but that's not enough because stewardship and investment choices shape outcomes for a much wider group of actors. And you can see here some examples, right? So you have end investors across generations whose retirement outcomes depend on stewardship. You have workers and communities impeded in investee assets, not just in public companies, but also in all the different types of assets. You have ecosystems and natural capital, but you also have the market stability itself. So these actors here are not principals in any legal sense. They're not parties to investment contracts, but they're affected by how capital is allocated, by how capital is governed, and by how capital is withdrawn. And this is where stewardship becomes a question of legitimacy, not just about incentives. So if institutional investors exercise power with those systemic consequences, stewardship cannot remain blind to those unseen others, even where legal duties remain narrowly defined. Let me be clear for a moment about what this does not mean. It doesn't mean that investors owe fiduciary duties to everybody affected by their decisions, but it does mean that stewardship cannot remain blind to those consequences. And I think that this is the gap that has generated a lot of debate over the past 10 years or so. And this is precisely the gap that neither the agency theory nor traditional fiduciary logic can fully resolve on its own. And this is where the model of enlightened investor stewardship comes in. So, by enlightened investor steward, I mean an institutional actor that operates, of course, under real legal, contractual, and market constraints. So, you still have fiduciary duties. Fiduciary duties still matter. Mandates still matter. Competition still matters. But what distinguishes this enlightened actor is a capacity for judgment. An enlightened steward must navigate tensions between value and values, between short term performance and between long term performance, between legal duty and normative expectations, and between private mandates and public consequences. Of course, we cannot eliminate those tensions, right? And we cannot pretend that they do not exist. And we need to bear in mind that when I'm talking about enlightened steward, I'm not talking about a moral hero or about an activist by default. Not every enlightened steward is going to be an activist, but I'm talking about how the tensions can be managed. And this is the capacity to explain why certain priorities are set, why certain risks are treated as material, and why particular trade-offs are accepted rather than denied. So it's not about doing everything or serving everyone, but it's more about recognizing which stewardship relationships are engaged and justifying not only on behalf of whom you're acting, but also for who others you're acting. So it's not an expansion of legal duty, but is more a kind of an evolution of how stewardship responsibility is understood and exercised. Now, what I need to add, and I think I mentioned that before, but just to be clear, when we're talking about stewardship, we are talking about a multi-level practice, right? So originally stewardship was about the micro level, so it was about asset-specific oversight, but currently it's more about portfolio level, so it's more about capital allocation, portfolio design, portfolio level engagement, and this is really relevant for passive investors. But it's also about system level, so about market-wide norms, systemic risks, and even about policymaking at the macro level. So you have all these four levels. And of course, it doesn't mean that all investors are going to operate across all levels. It's not about that, because of course every investor is different in terms of mandate, capacity, position. But what needs to be clear is which levels are engaged and why. And of course, as I said, obviously a passive manager is going to engage differently compared to an active manager or compared to a public pension fund, right? So it's not about who is better, but it's more about stewardship. It is about credible stewardship and about stewardship depending on alignment between the mandate, the capacity, and the level of intervention. Now, let me now bring the regulation in. As we're all aware, stewardship codes have become really popular over the past 10 years or so. Today, there are more than 24 jurisdictions with stewardship codes. But the reality is that stewardship codes are often misunderstood. They are frequently assessed as enforcement tools, and the success of a stewardship code is often judged whether they compel engagement or whether they produce uniform behavior. But this is a mistake in my view, because stewardship codes are not substitutes for hard law. They are not designed to discipline investors, but they are more what I call normative infrastructure. So they are, of course, one size fits does not fit all. And clearly, stewardship code is not just about firm level engagement. They are more kind of a response to the complexity of the investment chain that I described before. So they are kind of gap fillers. They operate in the spaces where law runs out. So they operate not in that client-stewardship relationship, but in the other three relationships that I mentioned before. And in my book, I go over that crowding in function of stewardship code. So they try to shape stewardship, but without mandating outcomes. Now, let me apply that to the UK code. I'm not going to go over the first generation, the 2010, 2012, because I think we're all familiar with that. But I think there is an important aspect that I want to emphasize when it comes to the 2020 code. And I will move quickly to the 2026. But when it comes to the 2020 code, I think it is clear that there was a lot of ambition. It is clear that there was a lot of ambition, especially when it comes to sustainability stewardship. So to systemic risk awareness, to that kind of system level and market level stewardship. But at the same time, there were clear limits as well. It was very ambitious, but it was equity centric. So even though it was expanded across different assets, materiality was unclear, accountability was diffuse, and it wasn't really clear how you can exercise stewardship outside of equity. Now, the new code, the 2026 code, I would say it's not a radical departure from the 2020 version, but is a kind of recalibration. I will give you one example. Look at the definition of the code, because I think the definition of stewardship in the 2026 code is telling. Stewardship is framed as the creation of value for clients and beneficiaries. So we have these important change compared to the 2020 code with regard to the economy, the environment, and society. So in my view, this change in ordering, it does matter because it reaffirms client stewardship, it reaffirms client primacy while keeping those systemic risks, those wider risks in view. So if you see the code in that context, I think the trajectory from 2020 to 2026 is really important. Of course, I'm not going to go over to the other changes given the time limits, but I think the direction of travel is clear. I think it is clear that the code, the 2026 code, tries to be more pragmatic. because it recognizes stewards as systemic actors, but also recognizes this client stewardship. And I think in general, the code reveals the limits of that second generation framework of codes because it leaves unresolved how responsibility should be justified. In my view, it's not about whether or not investors should consider systemic effects. It's more about how responsibility for those effects should be justified. And I'm going to close with what I described in my work as a third generation UK stewardship code. Of course, this is not a kind of call to expand investor duties and is not an attempt to import stakeholder governance into stewardship, but is an attempt to take inspiration from Section 172 of the UK Companies Act 2006. I'm sure that we're all familiar with this section, and to bring this orientation into stewardship. Section 172 does not ask directors to serve everyone. I think we're all agree on that. But it asks them to pursue the success of the company with regard to wider impacts. And I think that this logic needs to be applied to investor stewardship. So a third generation code would define stewardship as the responsible exercise of investor power. So you have power on behalf of clients. So we need to emphasize on the mandate here because it's all about mandate success. But in doing so, an institutional investor needs to regard the wider impacts, the systemic risks, the long-term conditions that shape value. And these are the unseen others. And of course, this has important implications for materiality, as you may expect, because we cannot, a third generation code cannot impose a single definition of materiality. And of course, such a code is going to ask a shift from activity reporting to reason giving. So stewardship reporting should focus less on what was done and more on how priorities were set, how conflicts were handled, how short-term and long-term considerations were weighted, how wider impacts were taken into account. And I think this is where Section 172 analogy can really make a good work. So let me now close. I think I gave you a lot of food for thought, but let me end by returning to the question I posed at the start. And the question is, what is investor stewardship actually for? And my argument today has been that stewardship has outgrown its original frame. It's no longer just about engagement. It's not about fixing agency problems at the firm level. Investors exercise power across assets, across portfolios, across systems, and that power carries consequences for a range of unseen others. So the challenge, in my view, is not whether investors should act responsibly, but the challenge is whether we have a governance framework which is capable of making that responsibility justifiable. So what I have called in my work as enlightened investor stewardship is an attempt to provide that framework. I think that the problem with stewardship today is not that expectations are too high, but it's more that responsibility remains underspecified. And I think that the third generation code would demand better reasoning, and it should ask investors not simply what they did, but why those choices were justified. So I think that if it is to take stewardship seriously as a form of delegated authority, we need to ask that step. Thank you very much, and I very much look forward to the questions. Thank you.
Thank you so much, Dionysia. And it was a great presentation. I keep taking some notes because it's also very close to my research area as well. I enjoyed that a lot. I'm sure others they agree with me as well. So now I would like to give a chance to anyone who wants to ask questions. Please either, I don't know, raise your hand or just unmute yourself and ask the question. Okay, I think someone has. Okay,
Hi,
so yeah, hello.
Subrana.
Hi.
Hi. My name is Rangika, and thank you so much for the presentation, Dionysia. It's really interesting to see what you have mentioned in the presentation. My question is about the trade-offs that you mentioned and how these decisions have been made. And you made that direct comparison kind of with Section 172. So my question is, for this new model that you are suggesting and how trade-offs reasons have been given, what lessons can be drawn from the experience with 172 to predict what might be the presentation mode of these reasons and trade-offs, how they are being reported? Is there any indication from how 172 has been applied in the context of directors' duties, what we can expect in the context of shareholders and these institutional investors, and and whether those lessons indicate for a positive enforcement or as a mechanism of positive enforcement? If that question makes sense, I'm more than happy to clarify it if it doesn't. Thank you so much.
Thank you. Shall I reply that, Samana?
Yes,
Okay.
yes, yes.
Right, thank you. It's a really important question, and I didn't have the time to go through the details of the model here. Um, Two quick points on that. It is an analogy, of course, right? Because obviously there are differences. I think and we need to appreciate the Section 172 is very contested in company law. I think one of the main issues around Section 172 has first to do with shareholder prioritization, because even that, it is very contested. So, for company law, it is very contested whether directors should serve shareholders first, and in doing so, taking into account the other interests. For instance, in India, or in other models around the world, this is not accepted. It's more kind of stakeholder models, right? So I think the starting point is different. In my view, when you apply the analogy in stewardship, it's not as contested, because in my view, I think it is clear and widely acceptable that institutional investors act for the clients first and the beneficiaries. So I think that first of all, this element, the starting point is different. So I think it's even easier to apply 172 in stewardship compared to company law, because there is more agreement as who are those that you serve, primarily. That's the first point. The second point, and one of the other weaknesses of Section 172, it is about enforcement. But I think that we shouldn't forget that Section 172 is hard law, whereas incorporating the analogy under stewardship code is going to be soft law. So again, you don't have those expectations in terms of enforcement, right? Because of course, a code is a different animal whatsoever, right? A code is not about enforcement, it's about accountability, it's about disclosure. So if you look at I think even the current code, the 2026, because I was I followed really closely the consultation. I think it does have an element of Section 172 in the sense that if you compare the new code to the 2021, you will see that it's about clients first with regard the others. So I think that we already see that, but I think that needs to be more, that we need to exemplify that a bit more so it is clear what are the expectations on behalf of institutional investors. But the question is a really important one.
Yeah, thank you so much. Thank you. So Abdulaziz, do you want to ask your question?
Yeah, thank you. Can you hear me?
Yes, yes.
Yeah, thank you for this wonderful presentation. I just would like to ask about the index investing. We know with the growth of the index investing, who will be the steward in this situation? Is it the investor himself when he, like, for example, invests in an index fund, or will be the asset management firm that has been constructed this index fund? And if it is the asset management firm, will be their responsibility as a steward? Because they will have different diverse end investors with different investment horizon and priorities and so on. So what's the responsibility that will be for the asset management firm for the index funds? Thank you.
Thank you. Yes, thank you. Again, really important question and goes back to what I explained before. Stewardship is not a single relationship. Stewardship is not a monolithic relationship. You have multiple stewardship relationships at different levels. And I think, Abdulaziz, in your question, in a way, you predicted the answer. So they are both going to be stewards, but they are going to be stewards at different levels. In my book also, I expand on this idea of direct and indirect steward. I didn't include that in the presentation because of the time limit. So in the example that you described, you're going to have direct stewards, indirect stewards, you are going to have client stewards at different levels. And then in terms of responsibilities, in my view, the starting point is the mandate. So you first start with a mandate, and this is the on behalf of others element, but then you need to consider who are the unseen others. And the hope is that across all the different stewardship relationships, most of those unseen others are going to be the same. So there are not going to be as many conflicts of interest as we may expect. But of course, conflicts may arise, and in that case, it is about prioritization. So that's why I'm saying that the next generation stewardship code should focus a lot on how those priorities are set, on how conflicts are handled, and how different others are weighted.
Great. Thank you so much.
Thank you very much. Thank you.
Yeah, great. Thank you. I also have a question about stewardship reporting. If I don't know if have you identified any change in the way that signatories of the stewardship code they report about their activities through the years? If you look back at 2012, because when I started my PhD 2012, when I look at some of those stewardship reports, some of them they were very descriptive and brief, or even one page. But now I see like it's developed a lot. I would really like to hear about your observation. Yeah.
Thank you. Thank you, Samana. This is a whole chapter in my book, so maybe we need another seminar just to look at disclosures. So, as part of my work, what I did, I collected all the stewardship statements, both from the first generation code and the second generation code. And so we're talking about, I think, like 6-7 million words. I applied NLP and structural topic modeling and tried exactly to do what you just said, to identify those trends, what has been changed. Very briefly, some of the important things, of course, the size. You correctly identified that the size of stewardship reports has increased exponentially, especially among asset managers compared to asset owners, but is also a change in the language, which of course reflects the code itself, right? And the changes in the code. So obviously, as you may expect, this idea of systemic steward, this appears only under the 2020 disclosures, or this kind of idea of enlightened steward at the portfolio level. So again, these are ideas that are more relevant for 2020 reporting. And I think it's quite interesting. Of course, it's just the first year, but I think it would be interesting to see how this is going to change. My prediction is that the FRC wants to move to shorter statements. I think, the current situation where you have a stewardship statement as part of the sustainability report and the investor has to read 100 pages to identify the stewardship policy, I don't think that this is helpful for everyone. So my understanding is that this changes, but I'm not sure if this is going to have a cost in terms of what kind of information you are going to include. So I think that this is where the debate currently is.
Okay, great. Thank you so much. Very interesting. And I see also Aramoga. I hope I say your name correctly. Yeah, please ask your question. Hi, hello.
It's me. Hello, hi. Thanks for this wonderful presentation. Dionysia, I just want to ask you something. It just came to mind. It's fantastic, corporate governance, and it's been there for a long time. And then I had a huge gap, and then when this presentation came up, and I joined. Now, from my understanding, if I look at the timeline of the corporate governance, it's been there even before 9th century, when we have the stewardship theory, and then we had agency theory that you mentioned in your presentation. Then we're kind of going back to the drawing table again. We're going back to the stewardship theory, but it's basically enlightened stewardship theory. And also what I'm gathering is, so the enlightened stewardship theories, you trying to find the balance between the fiduciary duties with responsibilities to wider shareholders and those people involved in the series of corporate process or decision making or investment process. Now my question is, now we have one in section 172, and if you look at section 172, it specifically mentioned that is for large organization, But in the UK perspective, almost 97.8% of UK's are SMEs, right? They're not large organization. Now, from the SMEs perspective, how do you think, the stewardship theory or the stewardship code is relevant from the SMEs perspective?
Okay, thank you for the question. I think you mixed a bit a couple of things in your question, to be honest, because we need to keep corporate governance and stewardship separate. Of course, there are links, but these two are two separate things because corporate governance is mostly about companies. Yes, of course. Whereas stewardship is more about institutional investors. That's one thing. Section 172, again, from a legal perspective, applies across all companies. So it's not relevant just for large companies, applies across all companies. But in terms of SMEs, I think your point is quite important. And I think the last two codes, the 2020 and the 2026, are explicit that stewardship is relevant for all assets, right? Stewardship is not just for public equity, it's also for private equity. And I think that's where SMEs are becoming important. I think if you have an interest on SMEs from the perspective of stewardship, it would be interesting to look at some of the some of the reports. From my work on stewardship report, I have seen that especially large asset managers, they do focus on how stewardship is relevant across different assets, including SMEs, and also some smaller boutique funds. So you have specific funds for focusing on real assets or infrastructure. So again, here, there is an impact from the perspective of SMEs. So it is an evolving topic. It's not a topic with a long history. And of course, it really depends on who signed up to the code, who are the signatories, because obviously, if you only have those big non-UK investors, then, SMEs are not going to be the most relevant topic. But if more and more investors sign up, and investors with larger diversification, then SMEs are going to be more important. But the framework as a framework should apply in the same way because the framework is not prescriptive.
The reason I ask you, because if you look at section 172, 1, bracket 1, it clearly categorically mentioned that from January 2019, the large companies are required to include the section 1 to 7, bracket 1, subsection 1 statement in the strategic report. Now, when you say the large companies, I mean, obviously large companies is basically outside the three categories of SMEs we have. So kind of me asking me, are they relevant? Are they basically including SMEs? Because obviously large companies, any companies, because we follow the SMEs as a large company by numbers and the size. But from my interpretation, the large companies is basically any companies who are beyond 250 employees. So that's my interpretation. Maybe I need to look at the reports and I need
No. Again, I'm not sure how much time we have, but again, I think these are two different things. Section 172 applies across all companies, but then 172 statement, so the reporting element, the reporting requirement is compulsory for large companies. It doesn't mean that an SME, that the directors of an SME should not apply Section 172, is the reporting requirement that does not apply. But again, when it comes to stewardship, this is just the analogy, right? So the analogy is that, like directors that take into account different interests, institutional investors should also take into account different interests. So in my view, this is no different irrespective of the size of the company.
Fair enough. Thank you. Thank you.
Okay, thank you so much, everyone. Thank you for joining us, and also thank you to Dionysia. We really enjoyed your session. I'm just going to stop the record.